Thought leadership from PwC's National Office.
Welcome to PwC's Accounting Podcast. I'm Heather Horn. Today we're wrapping up our series on the Loans and Investments Guide, and we're going back to the basics with a discussion of the accounting for equity investments, a topic that transcends industries and company size to impact almost everyone.
If you think about how some companies get these equity investments, some of them, they're making it for investment purposes, like it's part of their investment strategy. Others, the reason is more complicated. You know, it's a vendor, it's a customer, it's someone you're sort of making a bit of a strategic investment in that you want to be able to see what's going on and then jump in if the company that you're investing in becomes more successful or has a product that launches and things like that. So there's a lot of strategic reasons why you might be in these instruments. Think about which accounting model you apply, like Chris said, very, very carefully. Like, what's the financial reporting implications of fair value through P&L? What are people going to think about the measurement alternative where you can have sudden shocks in earnings, either, upward or impairments downward that, sort of kind of pop in a given quarter?
That was Chip Curry, who's joined by Chris Trudeau, both partners in PwC's National Office with extensive experience on this topic. They'll help break down the accounting and share some helpful insights. So let's start the episode. Chip, Chris, thanks so much for joining me today for our series around topics from the Loans and Investments Guide. And I think today's topic is one that almost everyone will have dealt with at some point and probably on a semi-regular basis, and that would be accounting for equity investments. And I know that this is not an area that's always completely straightforward. So maybe before we start things off, it would be helpful just to understand a roadmap of the accounting guidance. So Chris, can I go to you for that?
Yeah, sure. So, when you're talking about equity instruments, there's a lot that you can wind up needing to think about. And you really need like a disciplined approach to kind of walking through all the different aspects that you can find yourself in. For the majority of folks, like you really want to start off with a consolidation, right? So that's kind of the first place to start with equity instruments. And, do you have control of the entity through your interest? And if so, would you be required to consolidate that entity? Because that kind of trumps all the other potential accounting.
Yes.
And obviously, consolidation is you bring all their assets and liabilities onto your books and do all the fun consolidation accounting that you don't want me talking about.
All right. So let's assume for the purposes of today's podcast, we're not consolidating. So then what?
So then the next thing is to think about whether the instruments that you have are either derivatives or would provide you with what's called significant influence and leads you into equity method accounting. So, probably for derivatives, it likely depends on what kind of instrument that you are invested in. Probably a straightforward share is generally not going to be a derivative. But oftentimes, equity instruments could be in the form of options or warrants or purchase forwards, forward sales, and forward purchases. And those could actually be derivatives, depending on generally comes down to if there's a net settlement feature, either because the entity's public, and so it's generally going to be readily convertible to cash, or there could be net share settle features or other things that could provide net settlement. So that's usually kind of the next place to go. Equity method is kind of a hybrid, if you will, of almost a pseudo consolidation for your relative ownership percentage, all mushed into one kind of line item in a way. Again, I'm not sure you want me talking too much about equity method, other than I know that you need to think about it. But
I think
we'll leave
both
those
of
for
those,
other days. I'm sure you must have other series.
Yeah, derivatives, yes, and I think equity method, if we don't, we should be adding that one. So yes, more to come on that.
Excellent. So some of you have gotten through, no consolidation, no derivative, and no equity method. You think you were done, but you're not really done. If for your listeners have listened to the debt instrument podcast, they may already know that there's another step, and that is that a legal form equity instrument could actually wind up being a debt instrument. I think probably the most common example of that is a preferred stock instrument that's either mandatorily redeemable or redeemable at the option of the investor. Definitionally, those are debt instruments because they somewhat are less like a direct ownership of the entity and are more like a debt relationship between the investor, you, and the entity you're invested in. So that's the fourth category of equity instruments before you actually get to equity instruments.
All right. So now let's assume I finally made it. I don't have any of those other accounting models that are applicable. Then I'm in the scope of ASC 321. But maybe one more question before we actually start to get into that, because Chris, this is a case where this is not, oh, I've acquired this investment, I'm going to evaluate it once and I'm finished and I decide which model I'm in. You may need to reassess.
That's correct. And yeah, I mean, the kind of like you said, we're at a point where we're in the scope of ASC 321, which is accounting for equity instruments. But you're right, like you need to continually assess whether that's the right place to be or not. And again, there's a number of things that could impact that assessment. We talked about equity method and consolidation. Well, ownership percentages can change, over time. Either you buy more securities, you sell more securities, the entity may do a transaction that increases or decreases your ownership percentage. All of that could lead to either consolidating or deconsolidating. If you kind of lose your ownership, you lose your control, could be in or out of the equity method of accounting. And so that could be one place where an assessment can change the model that you're in. We talked about the preferred stock example for debt security. There could be contingent features, or you could have redemption provisions that lapse or expire. And so they, go away and it's no longer redeemable. And now it is more like a true equity ownership. And so that could flip-flop between a debt security and an equity security. We talked about derivatives. Mm-hmm. Sometimes instruments that are not derivatives at inception wind up being a derivative. So, for example, we talked about a public company could provide a net settlement feature because it's readily convertible to cash. So if I initially invest, I have an option or a warrant in a private company, and then they do an IPO, that may now say, oh, what I have is readily convertible to cash. Now I'm a derivative. So yes, there's a lot of things that could change and force you in or out of 321 or something else. And that's something that you need to continually assess.
All right. And so then, Chip, maybe bringing you into the conversation, if I have an equity security and I've concluded all those other models don't apply, then I should apply ASC 321. Is that correct?
Yeah. I mean, one other thing we do find is, so you've worked your way through the model that Chris kind of articulated, and now you're left with 321. And I think there's still a little bit of confusion around kind of even the scope of 321. And I think part of that is if you actually read the codification, it's great. It's a lot of fun.
I was going to say, I'm sure
who wants to do that?
All our listeners are like running out to do that right now.
Yeah. I mean, you've got a vacation coming up, grab the codification, great poolside read. But if you were to read 321, you'll see the words equity security, equity security, equity security all the way through that. And so when people see that, they think, oh, this would only apply to something that is actually an equity security. Securities have a definition under GAAP. But that's not true. That's so like when you actually kind of double click and look further, if you look in the scope section of 321, it notes that 320 applies to all ownership interests. So that would include investments in partnerships. It would include unincorporated joint ventures, limited liability companies, things where they're equity instruments, but they wouldn't necessarily meet either the accounting or the legal definition of a security. So a lot of people see the word equity security, they sort of stop and you're like, no, it could apply to these other instruments as well. Another area where I think there's some confusion is the definition of an equity security in 321, or that 321 refers to, and Chris mentioned this a little bit earlier, it includes the right to acquire. So think like call options to purchase securities, or forward purchase contracts to purchase securities, or dispose of, so think forward sales and things like that, and ownership in entities at fixed or determinable prices. So now you might be confused because you might say like, well, hold on, Chris said some of these are derivatives.
Yes.
Yeah, Chip just said they meet the definition of equity security. And where that really comes down to is what Chris was mentioning. If you have a forward or an option contract and the forward or option has net settlement, so it either can be net cash, net share, or the asset that you would purchase is readily convertible to cash, you're going to get sucked into the derivative standard. So you're going to be in step 2, Chris, of your thing, you get pulled out in the derivative standard. But if you don't have that, if you have like a warrant, for example, like a purchased option, and the only way you can exercise it is by gross physical settlement, paying the exercise price and receiving those shares. If those shares are not readily convertible to cash, if it's like, say, a private company, as Chris mentioned, you won't be in 815, but you will be in 321. And so that's another area where people kind of get confused. Is like I said, they read that definition of equity security, or they read that language equity security, and they don't realize it applies to these other instruments as well. And there are a couple of scope exceptions in 321 that are spelled out, like things like Federal Home Loan Bank stock, and things like that, where there's already a different specialized accounting model for those things. But that's another area I think of confusion, is just this whole equity security is not really just limited to equity securities.
All right, that's helpful. Chris, any other examples you give where there's some surprise that ASC 321 applies instead of a different model?
Yeah, I mean, there are some instruments that folks have maybe been surprised about. I think probably the most common example would be a mutual fund investment that only invests in debt securities. It certainly feels like you have a debt security.
Mm-hmm.
It may kind of value a price like a debt security. You may invest in it because you're looking to invest in debt securities. But as Chip said, it's an ownership interest in a fund. So therefore it's an equity instrument. And a lot of people say, well, shouldn't I look through that? I mean, that's just kind of on paper.
Yeah.
I mean, really, what I have is, it's a debt instrument. It's a collection of debt instruments. And, the answer is no. You don't look through what you have. What you have is an ownership interest. So you would account for it as a equity investment, an equity instrument. Chip mentioned too, purchased options and forwards that are not derivatives. Some folks think, well, if I intend to apply the equity method of accounting, I think it qualifies. I mean, I should exclude that, right? And no, although an equity method investment would not be part of ASC 321, an option or a warrant to purchase an instrument may be an equity method once it's acquired. And so once you actually have that significant influence, would still be accounted for as an equity instrument under 321 while it's in that option or forward phase.
All right, a lot to think about. And I would like to say that I've always disliked the fact that the equity method of accounting has that name, which is so close to accounting for equity securities, just adds confusion there. So just, in case the FASB needs something to do, they could take that on.
They are taking a gender request. So.
There you go. Not sure that is high enough, but I do think it creates a lot of confusion. I'm just saying. Okay, but that said, we now know we're talking about accounting for equity securities, and we're in the scope of ASC 321, and as well the other things in the scope of 321. I don't want to overly influence that. So then what does the accounting look like?
Well, so we've finally determined after, 17 million steps that you go through?
Pretty much.
That you're in ASC 321. The basic model is it's fair value through earnings, right? And that's especially if you have a instrument with a readily determinable fair value. So what is that? What is a readily determinable fair value? Well, if you think about an instrument that is maybe currently available on a securities exchange registered with the SEC or an over-the-counter market where the sales and the prices are quoted and reported by the NASD, which is the National Association of Securities Dealers, automated quotations, or by the OTC Markets Group. If they have sales or bid-ask quotations, that's readily determinable fair value. Outside the U.S., if you think about like foreign markets, if there's securities traded in a foreign market that is of a similar breadth and scope to the U.S. Markets that I just mentioned, that would also likely qualify for readily determinable fair value. Or investments in mutual funds or those that are similar to mutual funds and they have a fair value per share that is determined and published and is the basis for current transactions, that would also qualify. An instrument that has readily determinable fair value must be mark to market through earnings.
All right. And that's fairly straightforward because you have this readily determinable fair value. So recording the investment at fair value through earnings is not complex. But there are many equity instruments where we do not have a readily determinable fair value. So just take an investment in a private company, for an example. So then, Chip, what model do we look to?
Yeah. So like Chris said, the default model is fair value through P&L for equity instruments that you invest in, so equity investments. So that's sort of the default model. You would still fair value those through P&L. But 321 does provide for something you can elect into, and you may hear that referred to as the measurement alternative. So how does the measurement alternative work? Well, first of all, it's something you have to make when you acquire the instrument. So on the date you acquire the instrument, you elect that you want to apply the measurement alternative. You cannot acquire instrument, do fair value through P&L accounting, and then subsequently elect the measurement elective. You have to elect the measurement alternative sort of at the acquisition date. The model is basically based upon it goes on the balance sheet at cost, and then you assess it for impairment. Having said that, if the company identifies that there's been an orderly transaction where there's either the identical security that you own or a similar security issued by the same investor, then what you need to do is you need to then remeasure the security to fair value. So if you think about it, it's like cost, assess it for impairment, and then if you see an observable price, that is a trigger to measure either the instrument up or down to its fair value.
Well, that's really the key part of the model, right? Is, that there's a orderly transaction and observable transaction price. The FASB really believed that all equity instruments should be mark to market. And they understood, though, that there's a lot of difficulty and time and cost associated with trying to determine a fair value for something that is not otherwise readily determinable. But they kind of figured, well, if there is a transaction for a same or similar security, that transaction price would be a good data point to determine fair value and take some of that burden off.
Yeah, it was kind of like you said. It was an attempt to reach middle ground, between what they thought was the best accounting model, which was fair value through P&L, and the practicality of some of the difficulty in measuring. Heather, to your point, like some certain non-public investments. Mm-hmm. Maybe a couple of other points just to highlight from on the measurement alternative. So once you elect into the measurement alternative, you can elect to discontinue applying it and start moving to fair value through P&L. The theory being that's where the FASB really wanted you anyway. So if you want to opt in, you can't go backwards. You can't start with fair value and go to measurement alternative, but you can go from measurement alternative to fair value. So there's a couple of consequences is if you start with measurement alternative and then you want to elect out and do real fair value accounting. So the first, not surprising, is that is an irrevocable election. Once you're on fair value, you can't come off. The other consequence of electing out of measurement alternative is you now have to measure any investment you have either in the same security or similar investments of the issuer at fair value through P&L. And that includes future purchases. So you elect it and then you opt out. You're sort of binding your hands with the ability to elect measurement alternative going forward for future acquisitions. So definitely something to keep in mind.
Okay, so Chip, I actually had a question that I jotted down, so maybe this is a good time to pause and answer it. So you mentioned at the beginning of this segment, and you also just reiterated the fact that you can elect the measurement alternative like once at the point of acquisition. So if I acquire some shares of a private company and I do not elect the measurement alternative, and then next year I acquire more shares in that same company, am I able to elect it then for the new shares?
Yes, you can elect the measurement alternative sort of on a inch by basis, unless you have elected the measurement alternative.
And then unelected.
And then unelected. That is the one time you now get bound and you are stuck with fair value through P&L for all future acquisitions. If you never apply the measurement alternative, or you apply it and you don't unelect it, if you acquire something in the future, you You could choose again, fair value or measurement alternative for those newly acquired instruments.
Okay, so then that was my second question that I think you just answered. So now I have two tranches of the same securities. And for the second tranche, I elected the measurement alternative. I can't change my mind about the first tranche.
Correct. Once you're on fair value through earnings,
it's done.
that's it.
Yep.
It's over.
Okay. That's very helpful. All right. You probably have some other points here then about applying the measurement alternative.
Yeah. So I guess similar to a theme that Chris mentioned early, there is a requirement to do reassessment. So if you elect the measurement alternative and the instrument no longer qualifies for measurement alternative, you have to stop. So the example would be you invested in a non-public security, the company goes public. Now it has a readily determinable fair value because that security trades on an exchange. No more measurement alternative. You have to go to fair value through P&L.
Okay, makes sense.
Which makes sense because
Yes.
now it's readily determinable fair value, and there's no sort of impediment from a practical perspective of computing fair value. And I guess the last thing I'd mention, it goes back to something Chris said earlier about investments in funds. If you have an investment in an instrument that qualifies for what's referred to as like the NAV practical expedient. So in the fair value guidance, so 820, there's sort of a practical expedient that says if instead of having to compute, full fair value, you can use the net asset value of a company and just mark to that and, effectively use that as a practical expedient to fair value. If it doesn't have a readily determinable fair value and the investee is sort of an investment company or it's applying investment company accounting. So if the instrument is eligible for that NAV practical expedient, you can't apply the measurement alternative. And again, the theory is if it's eligible for the NAV practical expedient, well, marking to NAV is not that difficult. The fund publishes NAV, you mark to it. So you don't need a measurement alternative. So that's another just kind of reminder from a scope or applicability standpoint.
All right. I think, Chip, that's helpful because I think this question does come up and that a lot of companies have investments that are accounted for using NAV. So it's
absolutely
important.
That practical expedient is something that is used frequently in the equities, investments accounting for, instruments that qualify.
All right. So it's almost like they have a different alternative to the measurement alternative.
Correct.
Or a different, yes.
Or said differently, you don't get multiple bites at the practicality thing. You get one. And
exactly.
For that,
yeah. All right. And then I guess another question you mentioned, I think this came up a couple of times, that if you're following the measurement alternative, if there is an observable transaction, then you need to measure it at fair value. But then I think impairment also comes into play here. So what is the impairment model under the measurement alternative, Chris?
Yeah, so maybe it's a little easier to start off with what is it not. It is not an other than temporary impairment. So folks may be used to some of the old OTTI views and thoughts, and you would kind of say, well, it may have a temporary blip in the fair value, but it'll recover it and we'll be fine. Well, that doesn't fly with the measurement alternative impairment model. There are no thresholds for significance. There's no defined triggers or anything like that. It's kind of simply, to the extent any of this is simple, but simply if there's a reason to believe that the fair value is below the carrying value, you would need to compute what the fair value is and record the impairment difference.
All right. And then just to be clear, so let's say in period, like I acquire it in the first period and the second period, there is an observable transaction, so I write it down. Now, let's say a year later, there's another observable transaction and the value goes up. Then at that point, I'm actually able to write it back up even above the original carrying amount. So it's pseudo fair value based on these observable transactions.
Well, that's the observable transaction, right? So yes, I mean, that's a data point for a new fair value. But on the other hand, if I had, determined that there was an impairment, so I wrote down the investment not because there was an observable transaction, but because I had reason to believe the fair value was lower. Let's say that there was a significant line that was discontinued, or a new competitor came in and put a lot of pressure, kind of on my revenues. Well, me being the entity that I'm invested in, I should say. So those could be reasons to believe that there is a decline in the fair value. I would have computed it. If now I say, oh, but we just developed this new product and things are looking tremendously great. Well, if there wasn't an orderly transaction and observable, price, an observable transaction, I can't decide to compute the fair value and now recover from that. There has to be, a true fair value transaction.
If you're under this measurement alternative.
Right, because otherwise you're at fair value anyway.
Yeah,
right?
or you're like picking and choosing when you want to apply fair value, basically. But to your point, you're saying even if you're under the measurement alternative, you need to do an impairment evaluation.
Right. I would say it maybe a little differently in that if you're under the measurement alternative, you must do an impairment, right? Because otherwise you're already recording fair value.
Yes, so you don't need to do that. All right, correct. That's helpful. And then maybe I know this may be a bit beyond what we're planning to talk about, but when we think about an observable transaction, if, the example I gave at the very beginning of this measurement alternative was, shares for a private company. And so what would be an observable transaction in that context? And again, for our listeners' benefit, this may not be complete. It's just to give some feeling of it. So either of you, Chris?
Well, I mean, it could be that, there's a new investor in the company and they invest in shares of the company and they're either the same or similar to the instrument you own. That could be an observable transaction. It could be that there was a publicized, sale of an investment from one investor to the other. So it doesn't have to come like from a new issuance from the company. That's another example.
Another example that people don't think about is you buy more of the security or you sell some of the security. That could create an observable transaction as well, which makes the model a little bizarre, right? Because assuming you're not in a world where you think there's an impairment, where you have an idea that fair value could be below amortized cost, you could effectively trigger a remeasurement of your investment
just by
selling a portion of it. Mm-hmm. And selling a portion creates an observable price, and then that would create a remeasurement event. So, there are definitely some interesting elements to the application of the model. But the model is, like you said, cost assessed for impairment. Chris made some very important points about impairment. There's no triggers. There's no significance thresholds. If you have any inclination whatsoever of fair value is below cost, you got to go compute fair value and see if it's impaired. And then you always have to look for observable transactions, because if there's an observable transaction of the same security or similar security, then you also have to react.
So from a practical point of view, are we seeing that many companies are calculating fair value frequently or quarterly anyway, because this question of could there be an impairment?
Yeah, I mean, so I think a lot of times people think about is this measurement alternative, all that
helpful,
practical or helpful?
Yes.
Yeah, because it's kind of hard, right, to sort of sit back and say, clearly there's no decrease in fair value, and perhaps if things have really, taken off well for the company since, maybe it's a little clearer, but, just kind of from a day-to-day perspective, some companies are, kind of left with or put in a position where they have to compute a fair value just to make sure they're not in an impairment. And so it's almost like you're doing the fair value anyway, but you only get to take the bad news.
The downside. Right. Yeah, interesting. And so, Chris, any other sort of points you'd make or questions you'd advise companies to think about before they elect the measurement alternative?
Well, there's probably a lot of process and controls around applying the measurement alternative. You really need to have a well thought out approach. You need to identify if there are observable transactions, right? So you need a process to do that. The FASB, says, it doesn't have to be something that's, exhaustive. You don't have to kind of scorch the earth to make sure there was no transaction, but there should be a robust, process to determine if there was a transaction in the first place. And then if there was, you need to then determine, well, is that the same security I have, or is that a similar security? Because it's not just that it's the exact same, issuance. It's the exact same class. It's the exact same, type of security, or exact same security, I should say, legally. It could be a similar security. And then if you have those, then you need to think about the transaction price. I mean, it's not simply mark to transaction price. It's mark to fair value. You still need to follow the concepts under ASC 820 as to what a fair value is. And the transaction price may be the fair value, or it may simply be a data point from which I need to adjust, for differences between, especially if you're in the perspective of having a similar security.
Mm-hmm. All right, that's very helpful. So this is not going to be based on an exhaustive survey of all companies that could potentially be using this measurement alternative, but from your guys' experience, do companies generally elect this when it's available to them, or it really is, you can't really see a trend?
I'm not sure I would say that there's an end-all be-all either way. I think that we see companies on both sides of it. I mean, there are plenty of elections of the measurement alternative. Part of the reason why we get a lot of questions on that. But there's just as many that have a process, a robust process around the fair value. And like I said before, sometimes you kind of get forced into having to do a fair value anyway, just to prove there's no impairment, and you wind up only being able to take the bad news and not the good news. So why go through all that hassle and have only the downside risks? So you have companies on both sides of it.
Yeah, I mean, I think you definitely do, and I think you have companies that always regret the decision they made, right? Like
either way, right?
Either way, like, man, I really wish I would have elected the measurement alternative, because what happened, I have a lot of P&L volatility because I bought the instrument, price went way up, so I would never have to worry about impairment, but now I'm marking it to market all the time, and so there's a lot of P&L volatility. You have other people who say like, oh man, I wish I didn't elect the measurement alternative for the reasons that Chris said, and I have to build all these processes and things like that to deal with it. So I think you've got companies on both sides. Now again, if you regretted electing the measurement alternative, you can elect out of it.
Yes, but not
without dealing with the ramifications of, you have to move other things to fair value through P&L, and you're kind of locked in going forward. So.
Yeah. And I guess maybe one last point is that this is on a security by security basis. So you can have some securities that are following the measurement alternative and then others that are not. This is not like an election that applies to all similar investments.
Other than, as Chip mentioned before, if you kind of elect out and go on to the fair value.
Very good. Very good point. Thank you. There's always an asterisk when it comes to accounting. Seems like it. So, all right. Well, that's definitely a lot to think about. Definitely much more complicated than maybe what people, think on the surface. Oh, it's an equity investment. It's fair value through earnings. So it's very important reminders there. Again, you guys both know this. I always like to wrap things up with some key reminders. So maybe Chris, starting with you, any reminders you'd give in terms of as people are thinking about their equity investments and accounting?
Yeah, I mean, it's maybe twofold in the same answer. And it's, you need to really have a disciplined, developed approach and process. And it's, when I say for multiple things, one is, as we talked through, there's 5, 6, 7 different places you can wind up in: consolidation, equity method, derivative, debt security, equity security, right? So you really need to understand what you're investing in and have a disciplined approach to thinking about that. But once you are there, you really need to make sure you have robust processes around fair value, and if you are going through the measurement alternative, around identifying, transactions and prices and things like that. So, disciplined, well thought out, robust process is probably the key takeaway for me.
All right. Great reminder. Chip?
Yeah, no, I think Chris, you're absolutely right. I mean, if you think about how some companies get these equity investments, some of them, they're making it for investment purposes, like it's part of their investment strategy. Others, the reason is more complicated. It's a vendor, it's a customer, it's someone you're sort of making a bit of a strategic investment in, that you want to be able to see what's going on and then jump in if the company that you're investing in becomes more successful or has a product that launches and things like that. So there's a lot of strategic reasons why you might be in these instruments. Think about which accounting model you apply, like Chris said, very, very carefully. Like, what's the financial reporting implications of fair value through P&L? What are people going to think about the measurement alternative, where you can have sudden shocks in earnings, either upward or impairments downward, that sort of kind of pop in a given quarter? So that would be my advice. Just really think it through, and to echo what Chris said, whatever choice you make sure you have all of the controls, processes, and procedures to apply that accounting model, and be prepared to change as facts change.
All right. Well, great reminders. And it's always such a pleasure to talk to both of you. Thanks so much for joining me today. That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors, including accountants and lawyers.